Hey, everybody. Thanks for tuning in to view our market update for the middle of 2023. A lot has happened in the beginning part of the year. We've seen interest rates kind of pause, then rise again, a little bit different than what we've experienced in the past. We still have the same kind of economic conditions we've had for the last, I don't know, year and a half to 2 years, where we have really, really, really low unemployment, meaning everyone is working. We have high wages, meaning all those people that are working are making a lot of money. And we have what we would still consider pretty high inflation. So the federal government or the Fed has a pretty hard decision to make coming up here in September, and hopefully we start to see some of the rate increases that they've been making start to slow the economy down. And remember that the general idea is that when they increase interest rates, it makes it harder for businesses to spend money and people to spend money because borrowing becomes more expensive. So when they spend less money, they're buying less things, which slows the economy down because one person's spending is another person's income, and it kind of keeps cycling through. So we thought this would take effect much, much sooner. In some ways, you could say we made the wrong call earlier in the year. And looking back, you could probably say that it was due to the fact that there was so much government stimulus, all the money that they pumped into the economy, still flowing through that cycle, that people are still spending the money that they received and spending it, then receiving more and spending it. And it keeps working its way through the economy, kind of holding this economy up, even though we had these record level raises. So stocks kind of rebounded quicker. With one caveat, the stock market has had kind of a comeback. However, majority of that comeback is due to the return of 7 stocks. A little bit of what I would call euphoria in the AI space. And so, NVIDIA, a bunch of the big tech names that you've already heard of, Amazon, Netflix, all of those are the ones that have kind of led the way. And so it makes me very uncomfortable saying, like, yes, this market comeback was something that is real and sustainable, because from a market broadening standpoint, if you brought it out away from those big tech companies, you see really mediocre results. In fact, if you get rid of those companies, the return is somewhere under 3%. Okay, so not great. Also, we have to kind of look forward as well as look backward and say, hey, what do we see coming? And where are the opportunities for growth? So that leads me to, like, what's my reaction to this now? Well, even while we're kind of preparing for this video, we are seeing oil kind of make a resurgence, meaning a few months ago, the Saudis decided that they were going to start reducing the production of oil by 1 million barrels per day. And immediately there wasn't much of an impact felt, but now what we're feeling is there's less supply of oil for the demand we have because recession fears are diminishing. Right? So if they're diminishing their recession fears, that means people are going to keep spending money, keep traveling, and use more oil, but there isn't as much oil because there hasn't been as much produced, which drives the price of oil per barrel up. So we've been waiting for this moment when that supply shortage would drive it up. We think it's going to continue, and it has been continuing. And so we're sitting in energy right now, trying to ride that back up. We also see that there's a renewed potential for treasuries to provide some return for us, not just stability into the future. Interest rates have risen to a point where they're starting to do like a hold and increase situation, but they haven't gotten to the point where they're going to start reducing things to stimulate the economy. So we are in a situation where we're kind of in a slowly buying into treasury standpoint as they slow the increases that they're making, so that we're there before they start lowering them. And treasuries also have kind of a dual personality, as we've talked about in the past, where they will sometimes act as a safe haven when stocks do poorly. So if we do end up in some sort of a recession or some sort of hard landing, treasuries could get a bounce just from the safety of them. The other thing that we're sitting in is gold right now, because gold does really well when the dollar does poorly. And as we go into a recession, things go badly. Gold typically has done well in the past. So we're getting some safety from that. As opposed to the bonds that aren't playing as well when interest rates rise, right? So we've shifted our safety and our growth methods. So our growth methods are oil, and actually we've started to focus a little bit internationally. And when I say internationally, I would think things like Asia, India, things like that. And here's why. The U.S. is currently has a federal government that's raising rates and actively trying to suppress growth, right? Because we have high inflation. So interest rates, keep going up. Overseas, internationally, and especially in emerging markets, they're in a situation where they have low inflation, okay, where their interest rates are really low and their governments are trying to stimulate growth. Okay, so we have two opposite ends, right? We have one area of the world where we have demographically lots and lots and lots of people, many, many people entering the middle class, which is typically where people spend more money. And we have a situation where their governments are trying to stimulate their growth versus US investment where we're trying to depress growth, right? The US market looks good, feels good, sounds good, but then remember, it's just those big 7 main tech companies that are driving all of our growth. So I feel more comfortable and more excited about providing growth by leveraging a little bit into the international community, riding the energy up a little bit, and then also using treasuries as a dual threat and gold as a dual threat, right? Both safety and growth. So that's kind of where we're positioning the portfolios right now. We've actively been trading in that and doing that currently. And so if you have any questions about that, we would love to talk it through with you. We're going to be doing our fall reviews coming up. So you'll be getting a call within the next few weeks to set up a review a couple weeks out. And we'll sit down and talk about your individual situation in person, through Zoom, or on the phone, whichever you prefer. So if you have any questions, don't hesitate to reach out. Thanks a lot.